Good evening. Thank you very much for joining us here on Urban Debate on Mirror Now. I am Heena Gambhir. The big focus that we have for you at this hour is what happened to the stock markets today. Stock market investors, in fact, in India lost around 10 lakh crore in two trading sessions, with bears taking control of the Dalal Street today. Sensex as well as Nifty today fell about 3% in trade. Sensex lost 1,747 points to close at 56,405. It, in fact, closed below that crucial 57,000 mark today. However, Nifty too nosedived about 531 points to end the day below the crucial 17,000 mark. Now, last week too, markets have been quite volatile, but today was almost a bloodbath on the D Street. Now, this meltdown, viewers, was primarily due to escalating tensions between Russia and Ukraine. Some reports are suggesting that US President Joe Biden has told Western allies that Russia could launch an attack on Ukraine on 16th of February. This geopolitical tension has led to a sharp rise in crude oil prices, with Brent crude price crossing $95 per barrel mark. Now, there is fear that it may touch $100 per barrel as well. And this, viewers, is going to have a direct impact on inflation, not just in India, but across the world. Apart from this, there is another reason why markets are quite nervous, were quite nervous, especially today. The foreign investors have been pulling out money as well from the Indian stock market. These are some of the reasons behind the weakness that we saw on the Dalal Street today. Specifically, let's try and understand from our guest now about what should be the strategy of the investors. What should you do if you also are among those investors who have been losing money in the stock markets? And joining us on the broadcast this evening are two guests. We have Ajay Bagga, senior market expert, live with us. Ajay Srivastav, CEO, Dimensions Consulting Finance Services, also joining us live this evening. Good evening to both of you, gentlemen. Thank you very much for joining us here on Urban Debate on Mirror Now this evening. Mr. Ajay Bagga, I want to begin the discussion with you. You know, markets have been quite volatile last week as well, but what happened today was scary. About 3% cut. In your opinion, how bad is the situation, and what should really the investors be watching out for?
Yeah, it's very difficult to really forecast when it's a geopolitical risk that is on. Now, in 2014, when Russia did the Crimea annexation, the markets hardly moved, and the European GDP didn't have much of an impact. The risk premium went up about 20 basis points. Now, on the talk of a Ukraine action, we are seeing markets taking a worst-case scenario and selling off globally, not only in India. So a lot will now depend on what happens on the 16th or what happens on the 22nd. If talks are successful, you could see markets recovering very fast. There is a confluence of 2-3 factors. One, the geopolitics has become very center of plate, but there is the inflation issue and there is the Fed rate hike, which is normally seeing emerging markets lose foreign flows. You see foreign outflows as the dollar becomes stronger. So we have these three big factors which are hurting market sentiments, and markets were not cheap starting the year. Especially Indian markets were marked out as one of the more expensive markets. So it's a confluence of all these issues, but the immediate issue will really depend on how the talks between the Europe, US on one side and the Russians on the other side, how they play out, and is there an actual invasion or there is some action on the ground, then you can't really forecast. It could lead to some amount of more market mayhem. In Crimea, there was very little opposition. The Russians just walked in. Their fleet was already stationed there. So there was not very big loss of life. But now here, the Ukrainians are ready. They are well armed and they have the missiles. So there could be a severe loss of life on both sides if an action happens. And that could really rattle markets further. And then second order effects is the energy issue with the Germans. 46% of European gas comes from Russia. 29% of oil requirements come from Russia. Globally, 41% of palladium comes from Russia. So we
Right.
have a lot of dependence on Russia. Over to you.
Okay, Mr. Ajay Srivastav, now as we speak also, there are several developments that are taking place around the world as far as this Russia-Ukraine crisis is concerned. The role of Germany is important. Germany's chancellor, in fact, visited Ukraine earlier and has got plans to visit Moscow as well. But the way the situation is, what is your understanding of this and how severely it could impact markets going forward?
See, impact on the market is very clear. The fact that the FIs were selling in the last 6 months, and all it did was to accelerate the selling. That's what happened in the last 24, 48 hours, and that's the trigger which is today hurting the Indian market, is that accelerated FI selling across the board on what stocks they hold. Now, in that scenario, there's nothing much you can do at this point of time as an investor because all this is out of your control. What you have to be worried about is, even if things stabilize, then where should your portfolio be positioned? Because you can't help it. What happened in Ukraine, you can't help it. What happens to oil prices, you can't help it. All you got to work out for yourself is that where your portfolio is today and what should you be doing with it at this point of time. Should you be selling it, partly selling some stock, buying some stock? I think that's a challenge because there's so many variables, moving pieces that it can just complicate your life of an investor. You got to simplify by say, listen, 1 year from now, I want to be holding these stocks. Focus on that because this can muddle your mind and make you all the wrong decisions. Just put your mind to rest and says, all this, if it happens, worst case scenario, yes, it will happen, there's nothing I can do. But if things improve, if things go on, where should my portfolio be positioned? I would say put it that way. Otherwise, you'll scare yourself like hell as to what's going to happen around the world. Is the world ending tomorrow? Perhaps no. Is there going to be chaos for next few days? Perhaps yes, possibly. But the fact is that we, from Indian investor perspective, with a large domestic economy, need to focus on our stocks. We want to buy in and focus and just declutter your mind. So my view is just, yes, acknowledge the variables in the global market, but really focus on your portfolio, your stocks and Cs. Are they in sync with what India is going to be 6 to 9 months from now?
So, Mr. Srivastav, you're saying one shouldn't really get too bothered about the kind of news we are getting about Russia and Ukraine. In fact, stay focused. Do you suggest that investors right now should be in a wait and watch mode kind of a situation? Or do you think this is an opportunity for people to start buying what they've been wanting to buy, something that was a little expensive so far?
Of course, as I always say that, these are the opportunities you get to buy the stock which you always talk. You keep talking about FOMO, fear of missing out. No, you haven't missed out. The share price is even lower than what you thought you missed out. So, yes, it may fall tomorrow further. That could happen. But the fact remains that if you're building your portfolio and you missed out some of the stocks, then this is the time you start, and you don't have to buy everything upfront. If you say 100 rupee allocation, you can buy 10 rupees of that and 15 rupees of that and ride the storm with that 15 rupees. If it goes down, you pick up another 10 rupee worth of stock. But as long as you're committed to buying a stock, there is no better opportunity than chaos to buy into the stock market. Otherwise, and you cannot miss these opportunities because otherwise, how do you build a portfolio? You got to have a life of next 50 years or 30 years or 20 years. Your life is not going to end in 6 months or 5 years or 5 days. So focus on the fact that I want this stock, I want to buy it, I got 100 rupees, I will buy 10 rupees tomorrow no matter what happens. If it falls, I will buy maybe 15 instead of 10 rupees. And if it will fall, I'll buy another 10 rupees after that. So that you build up, so at the end of the crisis, you got a portfolio of stocks you want.
Okay, so Mr. Ajay Bagga, Mr. Ajay Srivastav is of the view that if this is chaos right now, he is seeing opportunity here. He wants the investors as well to see opportunity in this particular chaos. What is your suggestion to investors at this point in time? And if you could also tell us a little bit about how much the investors have really lost, say, in last 1 week, because volatility began last week itself. On Saturday as well, we had seen Sensex seeing a cut of about over 700 points.
Yeah, but we have to see it in perspective, and a lot of the money has come in post 2020 fall. So I would agree, with Ajay ji totally. You have to think strategic at times like this. You have to ignore the noise. What I would say is take out regular amounts and keep investing every month. That's the best mantra for the retail investors. 5 crore SIPs are running in India into mutual funds every month, bringing in about nearly 12,000 crores. That's giving strength to the market and it's giving returns to the retail investors. For all the non-retail HNIs, this is a good strategic moment to think, step back and see. There is no rush. I think the markets are in for some amount of turmoil as we get through Ukraine. Hopefully in the next 10, 15 days, you will have the Fed coming in. Just today, again, Bullard, the St. Louis president, has gone on a channel and said that we should accelerate removing the accommodation. So it's unfortunate. We are going back to 40 years back of central banking where every day one of the 28 Fed presidents comes and airs views and rattles the markets. But that is to be expected in a rate rise scenario. So high volatility this year. There will be a lot of noise. Look at your financial goals, look at your asset allocation and allocate accordingly into quality companies. India is growing. India will be the fastest growing economy this year and next year as well. The spends going into capex will have a multiplier into the economy, and we have a 58% domestic private consumption-based economy. So all those things are going for us. Focus back on that. The sectors, again, I would say, look at the India-focused cyclical recovery sectors. You would do well in those kind of scenarios.
Okay, Mr. Ajay Srivastav, any specific sectors that you would like to suggest to our viewers, because people have actually lost a lot of money in the last two trading sessions specifically. Of course, a lot is now going to depend upon what happens globally, what happens between Ukraine and Russia. But then the sword of rate hike is also hanging near the neck.
The beauty of the market is for every buyer, there is a seller. So there's a different point of view. I have exactly the opposite point of Mr. Bagga to say that capex spend in the budgeted so far will be a great thing for the market. It's a disaster, absolute disaster. And I'll tell you why it's a disaster. Because companies need to have people buying their products and services now. The capex comes in 3 to 5 years down the line. That's the kind of stuff. So the multiplier is delayed by a couple of years. The economy like India needs people buying today the products and services, the two-wheelers, the cars, the shampoos, the soaps, and so on and so forth. So if you don't have a consuming economy, robust economy, there is no way the companies will do well. The result of this quarter show that there are less than 20 companies which have done reasonably well compared to the previous quarter. And that's what the beauty of this thing is, that your choices of companies you want to buy is a very limited portfolio now of companies that are doing well in this market or expect to do well. Certainly, I would not, and I am not a great expert, but I can tell you that capex companies have not done well for last 5 years. They will not do well for next 5 years again because they are susceptible to the raw material cost indices, which they've hit them very badly. They take a contract to build let's take a plant, right? Steel prices go up by 4 times. Their margin is 8%. Even L&T's margin is less than 10% at this point of time. So where would they accommodate the cost increase? So that's why you don't see capex companies doing extremely well. You see retail companies doing well. You see a Titan doing well in this market because they're getting a monopoly. You're seeing a PVR doing well because they're seeing. And if you see the share prices, that's how they operate today. Also, you see what fell down. A person like Divi is an outlier, went up. A thing like Sapphire Suit did well, went up. But 90% of companies are struggling in this country. So as an investor, you got to focus and says, I need to be with the bigger names. It's not the sector. And certainly, capex sector is not something on a recommended list because I don't think that sector is going to do well. If the oil prices remain where they are today, which company is going to do capex given that oil prices are, the budget had taken a certain $73. The reality is 93 and 96 is touched today.
Yes.
Can you imagine what's going to happen to the consumption side? So therefore, I would say stick to the known names, the bigger names which have a monopoly status and have a consumer-facing side, and very strong balance sheet. Most critical, strong balance sheet, longer gestation companies, capex companies. And that's the beauty of the market. Two opinions obviously have to happen if a buyer or seller comes to the market.
Absolutely, but that's an interesting opinion that we've got. Mr. Ajay Bagga, now, do you see government or maybe RBI actually intervening, if this free fall really continues like this, considering that LIC IPO is something that the government is also going to be banking upon? Yesterday only the draft red herring prospectus was filed with the SEBI, and now markets are in complete, sort of state of turmoil right now.
No, RBI intervention in the markets, we really don't expect. RBI is looking at the monetary policy. They have kept it accommodative enough, even with rising inflation. So they have taken a studied call to remain accommodative. The fiscal stimulus is going through the economy. Again, as Mr. Srivastav said, I strongly believe that 7.5 lakh crores of capex, your road multiplier is 8 times, your ports, airports is many times. You're making 36 kilometers of roads a day. So it is going through. Look at, of course, consumption is 8% below the 2019 levels, and that RBI also made that as one of the causes for them to stay accommodative, that we have not really recovered as an economy which is 58% private consumption driven. Private capex comes 2 to 4 quarters after public capex has gone through in the cycle. Right now, your output gap is too high for private capex to come in. The PLI kind of capex will come in. It will come over 2 years, 3 years. I agree with him, but still, I think the economic growth is going to be there, 8 to 9%. You have a chance to pick your 15, 20 stocks, and you can make good money even in this kind of a market. Not to be rattled by these markets. Ignore the noise. Focus on your portfolio. Focus on your financial goals. That's the best advice.
All right. I think we've got some interesting advice for our viewers who are investors as well into the stock market. I appreciate both of you gentlemen, Mr. Ajay Srivastav as well as Ajay Bagga, for joining us here on Urban Debate on Mirror Now this evening.